You're watching the Daily Market Comment by Mario Sachkiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. The U.S. employment report left markets spinning on Friday. While non-farm payrolls overcame expectations by a solid margin, the unemployment rate paradoxically rose a touch, baffling traders and sparking a fresh round of volatility in most assets. Investors ultimately reached the verdict that this employment report was the best of all worlds. Strong, but not strong enough to force the Fed to take its foot off the accelerator straight away. This saw the market price out some Fed tightening risk, with the dollar and Treasury yields getting knocked down, while stocks powered higher to reach new record highs. This dollar retreat might be just a bump in the road, however. The labor market recovery will likely accelerate. The Biden administration is committed to raising real wages, and inflation might not cool quickly if rents go wild once the eviction moratorium expires this month. All this argues for the Fed to dial down its asset purchases soon, which spells upside risks for the dollar against low-yielding currencies like the yen. Over in energy markets, OPEC and its allies failed to agree on a path forward for production increases last week. The negotiations will continue today. Most members want to raise supply by a total of 2 million barrels by year-end, but the United Arab Emirates is blocking this proposal, seeking better terms for itself. Some compromise will most likely be reached soon, as the stakes are too high. Judging by the fact that oil prices remain elevated, the market seems to agree. All told, oil prices have been trading like a runaway train lately, but it's becoming harder to envision any massive gains from here. The next event to inject some volatility into the FX arena will be the Reserve Bank of Australia meeting early on Tuesday. It will be a tricky one. On the bright side, the Australian economy is doing phenomenally well, but the catch is that half the country is now back in a lockdown after new clusters of infections popped up and vaccinations have been slow. Therefore, the RBA could adopt a more flexible approach to its bond purchases, which would essentially be a tapering move, but stress that it doesn't expect to raise rates for a long time still, negating any massive rally in the Aussie. This was today's Daily Market Comment here at XM.com. Have a great week.